Right. Thank you very much, everybody, for joining today. I am absolutely delighted to present our webinar on private credit, 2025 trends and 2026 outlook. It's been a very interesting year with lots of twists and turns, which no doubt our panel will go into. Before we start, just a little bit of housekeeping. We are scheduled for 45 minutes today. There will be an opportunity for Q&A towards the end of the session. If you would like to submit a question, and please, we do encourage as many questions as possible. We would love to get to as many of you as possible. There is a Q&A function at the bottom of your screen. Please feel free to pop that in the chat and we will try to get to as many of those questions as possible. If we don't get a chance to come to answer those questions in the session, we will try and come back to you afterwards. So please do feel free to use that. We scheduled for 45 minutes. We may run over just a little bit depending on the Q&A, but I will do a hard stop at 4 o'clock just to respect everybody's time and the rest of the day. And the speakers, I'm just about to introduce them, but contact details will be available on the website, on the email that will come out after this session. We will mail around the materials that are shared today. And obviously, I think any of our speakers would be delighted to hear if there's any particular questions that you want to follow up with them on. So, please do feel free to do that as well. And without any further ado, I am delighted to introduce our panel. I think it's no exaggeration to say that the experience, the complexity of the deals, the value of the deals, the types of transactions that they have all been involved in, and the experience both as advisors and from the private credit perspective that they bring, is an absolute gift to have here today. So we are delighted to have them. Peter Williams is a partner and co-head of Cahill's private credit practice. Prior to joining Cahill, Peter worked at a market-leading direct lender and uses his experience to provide an insider's perspective on direct lending transactions. He represents private credit firms in complex debt financing transactions. Dan Amato is a partner in Cahill's private credit group. Dan provides a comprehensive perspective to his clients with experience representing private credit funds, syndicated lenders, and private equity sponsors and their portfolios in a broad range of transactions. And Sneha is a partner in Cahill's private credit group. Sneha provides an insider's perspective to private credit transactions, given her extensive experience at a market-leading direct lender. She represents private credit funds in complex debt financing transactions. As I say, we are absolutely delighted to have our panel here today. Thank you very much for sharing your time and your expertise in this forum. And I will hand over to Peter. I'm sure that is absolutely the most that everybody wants to hear from me. They've come here to hear from you guys today.
Well, Sophie, thank you for having us, and thank you to TermGrid for putting this on. It's really nice to be with everyone this morning or afternoon, depending on where in the world you are. So maybe if you go to the first slide, Sophie, we can kind of get into it. Sophie said, Peter Williams, I co-head Cahill's private credit group, and really, what we focus on is predominantly direct lending. So today's discussion is going to generally be on direct lending, although obviously when folks say private credit now, private credit is a pretty large tent, and it can mean a lot of things to a lot of people, but I think today the focus will generally be on direct lending. What we've seen in 25, maybe it wouldn't be as catchy as a title, but it's really more of the same, right? The demand supply dynamics, this sort of wave of LBOs that I think many people had predicted, may have been somewhat of wishful thinking, right? We have a lot of private equity funds that may have various portfolio companies where their hold times are of the sort of length where they'd love to monetize, love to see some exits. That being said, we haven't necessarily seen a huge uptick in LBO activity, in which case, we're still left with sort of LBO issuance being muted, and thus private credit, which is still raising funds, still having dry powder, obviously then, sort of finding deals to do and needing to make sure they're sort of seeing access to all the top LBOs. With that, because we've now had, I'd say numerous years of the private credit growth and expansion, you have a lot of funds now with scale, and you have a lot of private equity sponsors also with scale. And what we're seeing is, documentation is evolving, but we sort of, I think, found a little bit of a middle ground, a little bit of a plateau, if you will, on the LMEs. And of course, you can't have a private credit webinar without saying LME, because that's generally what LPs want to hear about and what folks want to hear about. So we'll touch on that a little bit as well. And similar to that, it really is that maturation of the core and the upper middle market, where you're seeing sort of repeat players, you're seeing repeat lender clubs, where obviously each deal is different, but at the same time, you're seeing, sponsors and lenders that have done plenty of deals together. So there's a level of comfort and sort of a level of understanding with respect to a lot of maybe the ancillary terms that have sort of settled and somewhat normalized. And then finally, similar to how folks have sort of wished the LBO environment to just take off, I also think we might have some folks on the more restructuring end of the spectrum that have sort of wished for this restructuring wave to also occur. And I just don't think we've seen that. I think we've definitely seen some idiosyncratic trends where maybe certain sectors have seen some secular declines that can lead to some restructurings, but it's not sort of a broad-based macro issue just yet. Not saying that there aren't various names that have idiosyncratic troubles again, and not everyone's portfolio is 100% green. There's definitely some watch list stuff, but I just don't think we've seen a complete sort of shift to, oh my gosh, my portfolio is on fire, all my borrowers are in trouble. And then maybe we'll once we sort of recap the year, we'll switch over to our crystal ball and what we're seeing in 26. And I think we'll continue to maybe see some LME evolution, not necessarily with transactions utilizing LMEs, because knock on wood, I don't think we've seen much actual LME activity in practice in private credit. But that being said, there's still some in terms of documentation, there's still some movement on the actual LME terms themselves. And then I think what we're continuing to see is, again, private credit is a big tent. There has been a lot of capital raised, and with that, I think there's a lot of focus and just general creativity and willingness to either lend into new areas, create new structures, really just expand what private credit can achieve, and we'll talk about that a little bit. And then finally, because you'll be sick of hearing from us over the course of the next 45 minutes, we'll leave some time for some questions. So feel free to pepper us with anything you may have. So with that, maybe I'll turn it over to my colleague, Dan Amato. And maybe, Dan, if you could talk about, again, because you can't have a private credit presentation without an LME discussion, maybe talk a little bit about LMEs and what we've seen from a documentation perspective, throughout the year.
Yeah, of course. Thanks, Peter. Without turning this into an LME presentation writ large, I think we continue to see LMEs be an overriding focus in underwriting, particularly on sponsor-based transactions. It's a significant focus of our entire portfolio of lender clients, from the largest to the smallest. Even though we haven't seen a corresponding increase in LME activity in private credit deals, frankly, other than a couple of very widely known examples, Pluralsight, we have not really seen a widespread use of LMEs in private credit. And I think that speaks to, the nature of the private credit lender. It's relationship lending, generally repeat players who are lending to the same sponsors for their transactions over and over again. That maturation has brought with it a little bit of a settling of terms on LME transactions. I think a year ago, there was a lot more that was up for grabs and up for negotiation than there is now. I think, things like J.Crew, Envision Protection are fairly well settled at this point and are typical in both the largest and the smallest deals, for the largest and most aggressive sponsors to smaller sponsors and smaller private credit shops. There is a little movement on Pluralsight protection, and I think we see a range of approaches on that. Some lenders want to ring fence specific assets, identify them by name, prevent them from being sold, and require pay down, even in large deals with blue chip sponsors. And it just goes to the nature of the lender and the transaction. And there are other deals where, lenders are willing to go without Pluralsight protection. And in many cases, this is dependent on the relationship with the sponsor and whether or not it's a trusted actor and whether it's somebody that they believe is going to try to do an LME at some point in time. The other protections, Chewy, protection has become fairly standard. Nobody likes it, but it exists and has been in the market for a long time. There's been a little movement on at-home and double dip. Obviously, a year ago, this was fairly new technology. I think now, regardless of deal size, it's fairly standard to require debt to non-guarantors or unsubs to be subordinated to kind of take away the at-home double dip risk. Similarly, CERTA protections have kind of coalesced, requiring all affected lenders consent to lien or payment subordination. And we have fairly standard exceptions that have trickled down from the syndicated loan market through the upper middle market and down into the core as well for dips and ROFRs and kind of the standard litany of things that you see there. Open market purchases, I think, is still a little up for grabs in the private credit market. I think 6 months ago or a year ago, privately negotiated transactions on open market purchases was kind of a new term in private credit. I think it's initially been pushed back on by lenders, and I think there's been mixed adaptation of that point in the market. Some larger deals you see that without much debate or discussion, but I think certainly in the lower middle market and core middle market, that's still a term that is up for grabs and one that's negotiated deal by deal.
Dan, are you seeing lenders show up and say, I need, this specific language, or how is sort of the negotiation on these deals, or is there some flexibility, and how does that sort of usually play out?
Yeah, I think that depends on the lender. It depends on the transaction. It depends on their history with the borrower or sponsor. There are certain deals where people show up with a list of, named LME protections that must be included by name, and you got to include them by name, and they're less focused on the actual formulations of them. There are other transactions, including very large ones, multi-billion-dollar club deals, where people are very focused on the specific language of the LME protection. I think more similar to what you'd historically expect in a lower middle market deal. So I think practice on that is really varied. It depends on experience, and how many reps people have with each other and the degree of trust that exists.
And maybe, speaking of that trust and just sort of the fact that, there tends to be relationships with sponsors, again, maybe setting aside non-sponsors deals, maybe that's a good segue to Sneha. Just how have we seen sort of the evolution of the club and sort of the maturation of those sort of terms, given, again, a lot of times it's not a first impression deal where it's the first time the lender's ever seen a credit agreement or the first time the lender's ever working with the sponsor. How have you seen that played out?
Thanks, Peter, and thanks, Dan. I think what has happened in the market is that, like everyone knows, right, private credit has become such a formidable, dominant force in sponsor financing with the sheer scale at which it is playing right now, that this whole market has matured quite significantly. And in particularly, the upper and middle market deals, the relationships with sponsors are not diffuse, but they are concentrated group of top managers, to your point, that, who've been providing flexible capital solutions for over a few decades now. And so there are repeat players. It is a relationship business, and at the core of it, that's where, the certainty of terms, the ease of execution that private credit can offer has been highlighted. And because it is such a relationship-driven business, in terms of the documentation structure, like the flexibility, the terms being negotiated, there is a lot of understanding of both the business and the terms that over the years has happened as the deals have evolved. And particularly when you think about like some of the largest deals that are happening in the private credit space, right? There is this evolution of jumbo private loans, which are those billion-dollar plus loans that we've all seen in some instances heard about, where that scale of the private credit lender is an incredibly important piece to that puzzle. And they have now been able to demonstrate that they can do deals, north of 7-8 billion on the private credit side, again, sort of underlining the point that this market of private credit has only grown and matured over the years. And in some ways, what happens is that because it's become such a competitive market where the lenders are competing, on pricing, on leverage, on the covenant flexibility in the upper, middle, and large cap deals, that we have seen some terms around those evolve over the period, and we'll get to, how we think about 2026, where the movement is. But to a large extent, things have plateaued in the kind of deals that we are seeing, the kind of terms that we're seeing in those deals. And as a natural sort of next step, we are also seeing, because of these large sponsors participating in the more core middle market deals, that there is a certain amount of documentation pressure that is placed in those deals as well. So we are moving from the upper market space to the middle market and seeing a certain kind of pressure on the documentation terms over there. And the kind of terms that we see most negotiated around would be things around the incremental debt capacity, for instance, right? Where you're talking about whether it comes to the MFN terms, MFN sunset, whether it comes to what is the capacity itself, particularly when you look at, unsecured debt capacity, there is some back and forth around whether you should permit no worse than test in certain instances, whether it should be limited to permitted acquisitions, whether it should be about certain very specific needs that the business has. We also have seen in the upper markets space deals getting cleared with no amort in certain instances. So just a straight up bullet repayment would be there. There is some back and forth that happens around the DDTL use of proceeds, particularly when it comes to things like general corporate purposes. Outside of that, what I'm also seeing is, which everyone is quite well aware of, the EBITDA add backs continue to remain a big focus, right? Like all of our basket capacity, everything around LME, at the crux of it, it will come down to how you look at EBITDA and how do you think of the credit and the business as a consequence of that. And so there is a lot of focus on the revenue synergies and add backs related to that. There are some other things that we've seen of late where, asset sales step downs have become quite common in the market as well, which maybe I would say 8 to 12 months back wasn't necessarily as common. But again, these are, in some ways, I would say that they're much more upper market terms. But to the point that I earlier made, there is a pressure that is being placed on the middle market documents and deals as well, particularly with the larger lenders participating there and the larger sponsors playing there. So it sort of bleeds into that space as well. I think the other things that, of course, everyone will always remain focused around is the pricing and the economics. We are seeing some movement around the leverage and pricing, but to a large extent, some of that has now, as we are almost closing the year, sort of plateaued out, at least as far as the pricing is concerned. And so maybe with that, we could probably talk about, Peter, I'll turn it over to you, particularly with like the distinction between the BSL and private credit space as to what you are seeing, from that perspective.
Yeah, and I think, Sneha, you make some interesting points around just the fact that, especially in the upper middle market, right, you have, again, a known quantity sort of lenders, and you have, a top tier sponsor set that seems to, continually be focusing on using private credit. And I think an interesting question we got in the chat is, at the most basic level, you say sponsors are their job, their fiduciary duty to their LPs is to maximize returns. How are lenders then getting comfortable with sort of any LME, leakage, if you will, notwithstanding that they can say relationships, et cetera, but if a sponsor is supposed to maximize returns and there's an LME sort of loophole, isn't that sort of a recipe for a sponsor to use that loophole? And I think with that, though, the point I'd make is private credit does have, I think, even relative to the BSL, and we've done some exercises where we've looked at BSL docs, we've looked at private credit docs, and BSL, a lot of it is, does your document have CERTA? And the answer is just yes or no. It's not, does your document have CERTA and what's the actual CERTA language? In private credit is, does your document have CERTA and what are the carve-outs? What are the various conditions, this, that, the other? So I do think, while there may in certain, especially upper middle market deals, there may be certain areas that could have more holes than others. I do think from a totality, what we're seeing is that the LME protections in private credit are just wholesale better. They're not perfect, but when we're thinking about relative to the BSL, they're better. And then I think when you layer the fact that they're better protections, when you think about a sponsor and you think about a situation that hasn't gone as planned, I think we're finding that the actual juice is not worth the squeeze. Even if there's a small area in a document they may be able to exploit for purposes of doing something LME-esque, the actual return on that and the ability for a sponsor to use that maneuver to then somehow see themselves through to getting some optionality, to getting some return. My hunch is in a lot of the scenarios, actually working with your small lender club to effectuate a restructuring or some sort of other solution is probably the more likely path to enhance those returns. And I'd say in those situations, no one's happy, right? Obviously the underwrite has not gone to plan, but I think we're more likely to see, because again, the private credit does have some guardrails on the types of LMEs you can do. I think we're seeing a lot of times in those situations that the sort of LME path is a lot more fraught and a lot more, it's more expensive, it's more uncertain in terms of the actual outcomes than a direct conversation with your counterparty who you probably have worked with repeatedly and have a good relationship. Again, no one's happy to have these discussions, but those tend to, I think, that sort of consensual solution as opposed to the LME solution tends to be the more traveled down path. And then Sneha, as you mentioned, I think it's important, direct lending in and of itself is a bunch of different sort of categories, right? There's lower middle market, there's middle market, there's upper middle market. And obviously, as you move into the various categories, there's some overlap and there's certain sponsors that'll do deals middle market, they'll do bigger deals too. So some terms can be somewhat similar. But I think what we're seeing is there's definitely, still very much terms that reflect a lower middle market deal. Like lower middle market deal, we're still seeing covenants. It's the middle market that I think sort of gets a little bit squishy. And frankly, even the definition of middle market, a couple of years ago, I would have heard people say, 20 to 40 million of EBITDA is middle market. Now it might be 40 to whatever, your particular LP pitch deck says the middle market is the middle market. But that's sort of an area where the middle market seems to be a little bit caught in both worlds, where we're seeing some term creep, filter down as sponsors do large cap deals and also do more middle market deals. We'll see lenders participating both in the large cap and the middle market. So they might be more accustomed to seeing some of the more quote aggressive terms. And that's where I think, when we think about, where we were last year to where we are now, that could be an area where terms in the middle market maybe have moved slightly more, to an advantageous place relative for a borrower relative to a lender, as again, we've seen some limited supply and we've seen some good credits trade. And I think the other thing, distinction to make is we typically work with a lot of times, performing credit lenders, senior secured lenders that do want to do good deals. Like they would rather do a good credit with okay terms than a bad credit with really tight terms. And I think obviously, though, if your fund focuses on distress, there's a different analysis there. But I think the majority of what we see is more performing upper middle market credit, in which case you're willing to necessarily maybe sacrifice some basket capacity here or there as a lender because you'd rather, again, lend to that good credit as opposed to being a lender last resort situation where, sure, you may have tight terms, but those tight terms come with the credit that, is deserving of tight terms. So I think that's where we're seeing sort of a lot of the pressure right now is in that middle market. Again, the lower middle market, I think because those deals are a little bit more specialized in that they're smaller, and there's certain lenders around that are a little more inflexible in terms, because again, it's reflective of the credit. Those terms are still staying relatively tight. Notwithstanding, though, I think if you look at a lower middle market doc now than 12 months ago versus 24 versus 30, keep going back in time, I think there's going to be more. You're going to see growers, you're going to see various baskets that again you probably wouldn't have seen a year, 2, 3, 4, 5 years ago. So the term creep is real, and it's definitely happening. I think just the rate of acceleration in the lower middle market is probably a touch slower than the middle market. And then obviously the upper middle market, where you're competing with the broadly syndicated loan, you almost necessarily have to be a little more flexible because the sponsor does have the BSL option. And maybe, through that, Dan, when we think about, the lower middle market, the upper middle market, and how do we think, though, about exit planning, and how are folks sort of, now that we have credits that may be a little longer in the tooth, like how are folks sort of working through that in their structures?
Yeah, I think we've seen a diversification in structures, particularly on exit planning over the last year, really 2 years, perhaps a little longer. Traditionally it was either you were thinking about an IPO or a sale, and potentially, hopefully not a downside. But, as sponsors have found more and more creative ways to exit their investments or to, return capital to investors, certainly a proliferation of structures within the debt documentation. One particular feature that we've seen in refinancings from the syndicated market into the private credit market is the introduction of portability. It's obviously a more friendly term in the private credit market than it is in syndicated markets. But we've seen that in a couple of different instances, which have allowed the debt to ride through in a trade, particularly in a deal that we worked on recently. We've also seen increasing cases of recapitalizations or minority investments, rolling over an existing sponsor's interest into a new investment as a new investor comes in, taking the majority. There have been a couple of public examples of that around PCI Pharma, for example. We've also seen a rise in GP-led secondaries. Obviously, a couple of larger private credit funds have been very active out fundraising in this space and announcing returns lately. But this has really become a booming area of the private credit market, and one that we expect to see develop over the next couple of years as as LP interests become more actively traded, continuation vehicles are continuing to be used, and firms are lining up to finance those types of transactions. It provides an easier way to return liquidity without a sale or an IPO or a new minority investor. And as private credit continues to mature and diversify its product base out of traditional, purely direct lending, this seems like a natural area for it to transition to as loans are being repaid and traded off.
And maybe, as we think about 25, which again seems a little bit settled in, I think again the dynamics are one of lowish volumes of LBOs and lenders again flush with dry powder, so you have some natural term pressure there, and that being said, you still have the LME sort of aspect where lenders are laser focused on that. Where do we go from here? I definitely think over the last few months, maybe Sophie, if you want to go to this third slide. These slides are not; these aren't necessarily our shadowing slides, so folks aren't missing anything here. But as we think about into 26, so if you can go to the next slide, where do we go from here? Given again we have a mature market, we have private credit lenders that seemingly have dry powder, we have private equity sponsors that seemingly need to be gearing up for sort of exits. Sneha, how are you thinking about sort of the end of this year and into next year? What's sort of the feeling, the boots on the ground?
Yeah, I think this was something I was getting to earlier, where given the level of focus that exists as is on the terms around EBITDA, and it is very unique to each business, there is a whole lot of negotiation that happens around there, right? On certain items, just to be clear, like it's not that wholesale EBITDA is necessarily being negotiated, but everyone is focused on the cost savings add back, the proliferation of revenue synergies, sort of as a next step in that. And so we are increasingly seeing much more asks around revenue synergies. This also ties into something that we are seeing much more in particularly the more than 50 million EBITDA businesses where deals have gotten cleared on the cover-like terms, and that's become way more common than it would have been, say, even last year. So I think over a third of deals, as you know, we were looking through some of the data, have cleared with the cover-like terms in that greater than 50 million EBITDA space, which is quite significant. Now, this doesn't necessarily, I keep hopping on the size of the business because, like all of us have been making that distinction, there are different spaces in which all the direct lenders are operating in. So some of this doesn't necessarily go to a lower middle market. As to the outlook for 2026, certainly we expect to see more pressure around cover-like deals as the landscape becomes more and more competitive. We expect to see the pressure around revenue synergies add backs being included, to what extent, and again, it comes down to the nature of it. So there is all of that to be kept in mind. But beyond that, I think that some of the other terms that we were talking about, whether it's incremental debt or terms around bullet repayment and no amort, I think that will continue to grow as the market continues to be competitive. We've also seen in this past year much more of PIK being offered upfront as a flexibility tool, and that is a distinction that private credit can always use in ways that is not offered necessarily in the broadly syndicated market. So that is something that we've seen quite often happen here. And I suspect that it would continue to be that way. So there is some of that push and pull that we'll continue to see in 2026.
And maybe, as we think about 26, I think, again, LMEs are such a focus. I think one interesting thing, and maybe this will come to fruition, maybe not, I have seen in more, special sits, more tighter deals, almost a complete LME blocker where you sort of just stop negotiation. You stop negotiating the various sort of laundry list of LME protections, and you almost just put a single covenant that says you can't do LMEs. Obviously, the wording of that is important. But that's one where I wonder if maybe to cut down on legal hours and to just sort of get to the heart of it, where you see some adoption of just a universal LME blocker on maybe some middle market, lower middle market deals. I don't know in the upper middle market, where I think the term set is almost pretty well sort of negotiated, and there you almost see changes of degrees versus a big sort of covenant like this. But that's one in 26. I wouldn't be shocked if we see more of that. Just again, cut down on a lot of the whack-a-mole, if you will, of the various LME provisions. You just kind of put an override. Obviously, the language of that override is important, and you don't want to cut off, legitimate business, operational flexibility. But that is something we've been seeing in, again, more the distressed world that might have a place in the lower middle market world. Again, more so to kind of cut down on a lot of the legal back and forth, where a sponsor says, look, I gave you, the LME blocker, like, let's move on, right? And as opposed to now, you're negotiating potentially a bunch of different LME sort of provisions ad hoc, in which case, while I bill by the hour, and that might be helpful for lawyers, it's not necessarily helpful for driving, efficient execution and getting your deals done on a cost-efficient basis. Dan, I wonder from your view, as we head into 26, which is hard to believe it's already here, give or take, what are your sort of crystal ball predictions? What are you seeing?
Sure. I'm actually going to start with a question from the audience, which I think tees this up well. We have a question as to whether we're going to see a race to the bottom on terms similar to the syndicated market. And, Peter talked to this a little bit at the outset, but, I think if you look back 5 years, the trend has certainly been loosening of terms, incorporation of technology from the syndicated markets, and that it gradually trickles down. I think there's been a bit of a pause on that in the last couple of months as terms have gotten, seemingly aggressive enough for everyone's taste. And, there's always going to be haggling on baskets and things like that, and those will be loosened. But in terms of core underwriting terms on covenants, on EBITDA definitions, that all seems to have paused a little bit. Over the long term, I would expect that will continue. So we'll see a continued deterioration in terms from a lender perspective, and certainly looser documentation. I think there's been a consolidation of the industry, certainly at the largest players at the top. But in the lower middle market and core middle market, there's still room for specialization of lending and specialization of lending groups. And I think in those sorts of transactions, the term creep is going to be mitigated because you're going to have specialty lenders lending into special, not industry jargon, special situations, but lending into certain industries or certain companies, certain sponsors, and they're going to maintain more term discipline. I think, on a macro level, private credit funds are holding the risk, hopefully to maturity and getting repaid. So underwriting is going to continue to be more disciplined and come at and underwrite from a different perspective than it does in the syndicated market. So I think, look, over time, a better business is going to get underwritten with looser terms, and that will generally continue. But there is some natural limitation on that in the private credit market. At the upper end of the market, to Peter's last point, I think we will continue to see, large cap deals, BSL replacement, whatever we want to call them, essentially deals with EBITDA over 100 million that are going to look increasingly like broadly syndicated deals, because that's their competition. It's not, lenders in the core and lower middle market. It's, what's going to clear a syndicated deal. And obviously there's an inclination by some private equity sponsors to private credit because of the speed of execution, the certainty of terms, the private nature of the restructuring, the lack of news reporting on it generally. So people will continue to use private credit and at increased spreads, but the terms are going to be played off each other increasingly in the coming year.
And I also think too, people don't necessarily appreciate the syndicated terms as well have gotten more, as they have the same supply sort of demand imbalances too, and have some of the same pressures we have in private credit, where the syndicated terms have also gotten more, borrower favorable as well. So I do think there's still sort of a healthy spread between BSL terms and private credit terms. It's just that spread has still, on an absolute basis, moved more in the borrower's favor over the last few years. Than again what it was 10 years ago, or pick your point in time. One more question here. Just in the thoughts of U.S. versus Europe, which has seen more borrower friendly terms. It's a competition. If you're a lender side person, maybe it's not a good competition, but I do think. As private credit has naturally scaled and started to do bigger deals, you're naturally starting to do cross-border businesses. You're running into global sponsors that are doing both European deals, both U.S. deals. You're running into counsel that are seeing both U.S. and Europe. So I think you're naturally seeing a lot of harmonization between the markets, where if you're a private equity sponsor and you just did a deal in the US last week and it was a widget company and it got this set of terms, and now you're doing a widget company in Europe, what those terms are, your counsel knows what those terms are. So I do think there's a natural inclination to, again, harmonize those markets. I do think there's still some idiosyncratic, various terms are looser here, various terms are looser there. So it's not necessarily apples to apples across, every single term. But that being said, there's definitely a little bit of a coming together of some of the looser terms, where I think historically Europe might have been a little bit tighter. But I know, Sneha, you've done a lot of work, in the European market. What are you sort of seeing there? What are your thoughts?
Yeah, I think one of the key distinctions, that we should keep in mind between US and European documentation, and things can continuously change, right, as we've seen across. But at the outset, bulk of the European credit agreements or loan agreements, they do not contain unrestricted sub. And so that just, setting that out for everyone so that we understand that the distinction in LMEs will be very different from that lens, because they don't have the designation capacity for most parts. The other piece that the European markets are growing, and they are growing at a very steady pace. They've not been, this year particularly has been very good on that side of the house. But at the same time, I would say that even more than the US, European market is a very small group of private credit lenders who can lend over there, because there are currency issues that come into play, more operational style concerns, and just as to how the fundraising has been. So that goes to, again, LME in some ways, right? Like, it is way stronger clubs, way smaller community that is looking at it. So there is much more of harmony around that group that will continue to play out in those deals. It's not like they haven't seen any, but at least on the private credit side, the documents are still in some parts much tighter than the documents that you see in the US market. There is other stuff which are looser, right? You have snooze and lose construct, which exists in Europe, and it exists in private credit deals, right? You don't have some of that here. So without getting too granular, I think there's just keeping in mind that the LME lens has to be very different for the two markets, at least as of how the documentation stand today, will be important as we continue to look at the European market and their growth story.
Sophie, maybe check in with you if there are any other questions.
There we go. Yes, sorry, just coming off mute. Yes, I know one that we wanted to cover to bring it up to a very topical subject is the implications of first brands and tricolor. I think this has obviously been making a lot of headlines in the sector. So, would love to get your take on the implications of that.
Yeah, and I think John Gray at Blackstone has actually put out some good videos on this, but it appears to us that some more asset-based sort of revolving type, receivable lending, that sort of thing, has somehow become a private credit issue. And while it's never good generally for the markets to see large losses in a fixed income in a loan sort of product, I think from what we're discovering, one, it looks like in both these instances there's a bunch of alleged fraud, and two, these seem to be sort of more bank deals and more, again, traditional sort of ABL type borrowings. So I'm just, notwithstanding that, it seems like the press has sort of picked up and sensationalized it and said this is almost the canary in the coal mine. I just don't know, and by the way, we're not really seeing it come up in any of our deals, because I don't know if there's any real correlation between fraud in a receivable sort of facility and a direct lending corporate deal in predominantly a sponsor-backed sort of market. So I think the short answer is I don't know if we see this mattering. Obviously, it does put a spotlight on underwriting. It puts a spotlight, I think, on auditors. And just making sure that, again, to the extent there something doesn't smell right, it's probably not right, and to do your diligence. But that being said, I do think our lenders are doing robust underwriting. They're really kicking tires. This is not a just where do I send the signature pages, where do I send the money sort of lender set that we work with. So again, it's unfortunate these names have sort of dominated the news cycle and somehow, ported over to being a private credit issue. But from what we're seeing, it seems like a pretty contained, isolated sort of set of, fraudulent actors, again, alleged, that have sort of led to this.
It certainly makes for good headlines, though, right? And lots of good talking points. So, yeah. I think if anybody else has any questions in the audience, please kind of put them in. Otherwise, I think, I had a few notes down here, maybe just to sum up some of the themes that we've been talking about. And please, add into that. LMEs remain a focus, a greater sort of prevalence of them, although a lot of the terms are actually sort of becoming settled, but not necessarily a greater use. So, you know, that's something we're kind of taking forward. This stratification of the markets between the large caps, the lower mid-market, the mid-market kind of squeezed in the middle, and how that's kind of getting the pressure. But you know, I think fundamentally private credit is extraordinarily resilient, and how it's responding to, you know, all of these pressures with increased liquidity, you know, kind of competition from the BSL market, but competing on terms, offering the flexibility. You know, we talked about, I think portability was mentioned, PICs, DDTLs, those kinds of things, where private credit is bringing something to the party every time to kind of continue to compete and offer, you know, value in these transactions. And just underlining it all, the importance of relationships. And fundamentally, this is a relationship-driven business, and again, that's an important kind of string to the bow that private credit brings. I'm sure I've missed many of the nuances of what you were saying, but is there anything else that you would like to offer as a kind of a summary on today's discussion?
No, Sophie, I think that was great, and I think again, it's really incredible to see where the private credit market is in 2025. I remember, I think I did like one of the first $1 billion unit tranches I saw was like, oh my God, we threw a party, and like, wow, we've really made it. And now, you know, $1 billion unit tranche comes across our desk and it's ho hum, like, okay, that's just what private credit does. So I think, you know, the maturation and just the scale of this market is unbelievable, and to your point, the flexibility that private credit does provide its borrowers is, you know, its calling card, whether that's flexibility and being able to get to an answer quickly, whether that's DDTL, portability, you name it. Private credit is looking, again, to do, you know, good credits at terms that they can underwrite and get comfortable with. So it's been amazing, and it's going to be something to keep an eye on in 26 as kind of things continue.
It's certainly going to be an interesting year going forward. So yeah, we're all looking forward to 2026, and certainly one that you know, it's been noted that there's a number of credits out there that, you know, something has to happen. So it's you know, it's going to be definitely an interesting year. Thank you very much, Peter, Dan, and Sneha, for your contributions today. You know, as I said at the beginning, it's such an honor to have such an experienced panel and drawing from such a wide range of experiences in the market. I think we're very honored for that. To anybody on the call, we will be sending out the materials afterwards. And again, I would encourage you to reach out to our panelists. I'm sure they'd be delighted for any particular questions that we were not able to get to today, or particular issues. I'm sure they would appreciate any contact. And please do reach out to TermGrid if, you know, we can facilitate that conversation as well. And thank you very much for your time today. We will make the recording and the materials available, as I said. Appreciate all of your time.
Thank you.
Thank you.